Welcome to Dezerv's monthly market update. In today's conversation, our co-founder Vaibhav Porwal will take us through three major aspects. First, what's driven the markets in October. Second, how these factors impact investors. And third, what investors should do in the coming few months. So Vaibhav, we've seen a significant correction in the Indian markets. Across different indices, we've seen a fall of 6 to 7%. How should investors look at this correction in the market?
First, let me talk about an interesting data point that the team spoke about. This is the largest monthly correction that we've seen for the last 55 months. A more than 5% correction in the market was witnessed last time during the COVID period. So it's a large correction, especially for investors who started investing after COVID period. So this kind of monthly correction they would have witnessed for the first time. Now coming to the factors, I'll talk about factors in the order of their relevance. First factor, which is most significant in my mind, is corporate earnings slowdown. Because of that, some sort of valuation re-rating happened in the market. Second factor was large selling by FIs. More than $10 billion worth of equity was sold by FIs during the month of October. Third factor, which I think is more driven by what we read on social media and what I call attention economy, is around US election. Now that we know the outcome, Trump has emerged victorious, I think that news can be put to rest. So these were the three factors that contributed to this correction in the market. First two factors are more relevant, third factor is not so much relevant.
Coming to the first important aspect, which is earnings. What do you think has impacted the earnings in this quarter?
So if you look at India's corporate earning growth for last 3-4 years, it was largely driven by government capex. A trickle-down impact of that was visible across sectors. So therefore, we saw rally in stocks across sectors, across industry. One sector which was struggling was consumption. Now, along with consumption, we saw slowdown in capex also. Large part of this slowdown can be attributed to the fact that we had our election, and during election period, government spending slowed down. As a result of that, we saw slowdown in consumption, we saw slowdown in capex, and both of these slowing down together has resulted into this earnings slowdown.
And we've seen a negative sentiment in investors as well. What do you think has driven the FII outflows?
So FII outflow, we are overplaying it. FIIs hold equity worth $800 billion in India. 10 billion, which is what they sold in the month of October, is 1.25% of their holding, which is not small by any stretch of imagination, but in their context, it's not very large also. My suspicion is they are moving away from India and moving to markets where they see much greater valuation comfort. Indian markets have been trading at premium valuation, and because of that, they might be moving money away from Indian market. And I think the second factor could be they were expecting Trump to win and announce big bang tax cuts in the US, and as a result of that, they expect US markets to do much better compared to the Indian markets. So some reallocation might be playing out there.
And coming to the third aspect, which is the US elections, of course now we know that Trump has emerged victorious, but how does this impact Indian markets?
So the only reference point of Trump that we have is his last term. During his last term, he was good with India. In fact, we saw a good friendship between Mr. Modi and Trump also, which played out during his India visit also. If he continues the same positioning, then India has nothing to worry about. One thing which has worried most of the Indian investors is his election talk around tariff increases. India need not worry too much about that. If at all he goes for tariff increases, China will get much more adversely impacted. India should benefit at the expense of China in that situation. Having said that, a lot of impacts could be there on the US markets. He's spoken about some aggressive corporate tax rate cut, spoken about expanding the size of the balance sheet. All of it can put pressure on US inflation. So that's my assessment of how he will behave with India, but knowing that this will be his last term with no room for re-election, he can do some unexpected thing.
And my next question is, Vaibhav, how should investors approach the coming few months?
So let's look at all the asset classes separately. Let's talk about equity. Equity markets volatility can increase significantly, not more so because of Indian factors, but because of global factors. Trump being Trump, you expect him to do something which is unexpected. That can impact the global markets, and impact of that can happen on Indian markets also. So I expect Indian markets to be much more volatile. Second factor that I would closely look at is corporate earning growth. We saw 2 quarters of slowdown, And in the next quarter also, if the slowdown persists, that will add the volatility further. So these are the two factors that I am looking at in equity. On the fixed income front, one thing which everyone is expecting is that fiscal deficit in the US will go up. And second, because Trump is talking about increase in tariffs, inflation in the US can remain higher. One asset class that we have repeatedly spoken about is gold. Gold, I continue to believe, is in a good place, and investors should continue to allocate part of their portfolio to gold.
And how should investors position their portfolios to capitalize on opportunities?
So let's look at investors in three different categories. Investors who are already fully invested in equity markets should look at their allocation and move towards the portfolio which is safer, companies which are of high quality, and companies which continue to deliver good earnings growth. Last 2 years, market witnessed broad-based rally and all kind of companies went up. Now is the time to relook at your portfolio and move towards high quality portfolio. For investors who are looking to allocate fresh capital in the equity market, they should stagger their investment over the next 6 months. So as I mentioned, I expect volatility to go up, and investors will be able to capitalize on that volatility if they stagger their investment over the next 6 months. Third set of investors who are looking to invest money in fixed income should lock in their money at the current yields. Yields are attractive, and investors will generate reasonably good returns if they lock in their money right now.
Thank you, Vaibhav. That was very insightful. That's all for today. Stay tuned for our next monthly market update.